Hello, beautiful people, and welcome to another brand new edition of the ITU Forex class, where we're going to be talking about risk management strategies for Forex traders. So, in this week's class, we're actually going to be building on what we've been learning throughout the past weeks, and also we're going to be talking about one of the aspects of Forex trading, which is probably, arguably, one of the most important pillars which you would need to master in order to become a consistently profitable Forex trader. So in this class, we're going to be looking at the different types of risk management strategies that there are out there, and you're also going to learn which one which one works best for your type of trading personality. So without wasting any more of your precious time, let's dive right into it, okay? So first things first. The way I have designed or crafted this class is we're going to be first talking about the theoretical aspects of the risk management strategies. And then once we're done with that, once we understand the logic behind that, we're now going to move on to the charts to look at how to actually practically apply what we've learned based on the concepts which we've talked about, okay? So first of all, what is risk management? Before we do anything else, what is risk management? Well, put simply, risk management is simply the act of managing the uncertainties that you're going to encounter in the market. When I say uncertainties, I mean most of us think of trading as you just look at the chart and then you analyze whether that chart is going to go up or down. And then when you've made that decision, you're either going to buy if it's going up, okay, you pick a point where you're going to buy, or you think it's going to go down and then you sell, so that you make a profit when it goes down. Okay, we think that's all that trading is. There's some truth to this, but the reality of trading is that even though we're just buying and selling tradable instruments, financial instruments, we're actually doing it in an environment where we can never be 100% certain of what is going to happen. Okay, so let me put it this way. Let's assume that based on your analysis, based on what you've learned in the market, okay, there's a certain type of pattern which you've identified that whenever it occurs in the market, XYZ, let's say the pattern is named XYZ. So when when pattern XYZ occurs in the market, usually on average, more often than not, pattern ABC is going to follow it. So let's look at it visually, okay? So let's say pattern XYZ is something that goes like, price just moves down like this. Then let's say that since this is the pattern, bear in mind that this is just an example, okay? So whenever you see this XYZ pattern occur in the market, usually you're going to see ABC follow up. Now, what does this have to do with anything? Well, trading, if you've been following some of the top names in the industry, you would have heard that they'll tell you that trading is a numbers game. Because even though when XYZ occurs in the market, usually what happens is ABC will follow that, right? But that doesn't happen 100% of the time. Because if it happened exactly like this 100% of the time, then everybody will become a billionaire. Let me put it like this. Let's say that every time you see pattern XYZ, let me just label it this way, pattern XYZ in the market, then ABC is going to happen. Let's assume that every time you see XYZ, ABC is going to happen. Okay? Now, the problem is, if every single time any trader in the world, wherever he is, learns that if you see XYZ in the market, ABC is going to follow, then what is to stop this trader immediately after he sees pattern XYZ from maybe funding his account or taking a loan from a bank or something worth $100 million or whatever the crazy amount is, and then whenever he sees that XYZ pattern, he'll just place a trade, and risk his entire account? Because if we're dealing with certainties here, that 100% certain every time you see XYZ in the market, ABC is going to happen, then what is to stop this trader from, like I told you, taking a loan of like $100 million and then betting every single penny of that $100 million on the trade setup, on a single trade setup, where he's risking that entire trading account that he has, 100% of his account, which in this case is $100 million, and maybe going for a 1:2 ratio, because every time this happens, okay, you're going to see, every time XYZ happens, when you enter a trade from the A pattern, for example, from the A leg, then it's going to move 1:2 risk to reward ratios, okay, of what you're risking. So he's basically risking his entire account, which is $100 million, to make $200 million. What's to stop anyone from doing that? The reason why I gave you this example is to help you see and understand that this is one of the reasons, this is one of the arguments why risk management is extremely important in the Forex market. Not only Forex market, whatever financial market you're trading, whatever technique you are trading in that financial market, if you don't have proper risk management, trust me, you're going to have a very, very hard time becoming a consistently profitable trader in the market. Because whatever pattern you identify, that pattern is not going to occur 100% of the time. So if you're trading market structure, okay, the idea is that, remember, the reason why I chose market structure as an example here is because we covered market structure just a couple of weeks ago, okay? So the idea behind market structure, if you remember, is that if the market is in an uptrending market, usually what we're going to see is higher highs and higher lows, the formation of higher highs and higher lows. There are two ways to take advantage of trading markets that are trending based on market structure. Is either you wait for a breakout when after you've established that the direction of the trend is maybe up or down, so in the case of an uptrending market, price is consistently forming higher highs and higher lows, okay? And higher lows, higher highs and higher lows, higher highs and higher lows. So this is basically the structure of an uptrending market. So the way to trade this market, like I told you, is if you're trading with the breakout trading technique, then you're going to be aiming for price to break above the previous resistance level where it couldn't move past, okay? And if you're trading based on a correction, based on a retracement, then you're going to actually wait for price to form that high where it can't move past and then pull back, some distance or take a couple of steps back from the high that it made so that you can, spot price rejection candlesticks and whatever, and then take a trade in the direction of the prevalent trend, which in this case would be an uptrend. Now, even though this is, in theory, what we expect during an uptrending market, this doesn't happen 100% of the time. What I mean is, even though we expect higher highs and higher lows to be formed during an uptrending market, a healthy uptrending market, there are times when price is going to form higher highs, higher lows, higher highs, and then out of the blue, instead of price respecting, the structure that we have in the market and holding that higher low, price is actually going to come all the way down to the previous higher low. Maybe even go lower than that before moving back up again. So for the times when this doesn't happen, if you are not practicing proper risk management, and you're risking all of your accounts balance or 50% of your accounts balance on a single trade because you think that every single time you see a market structure of an uptrending market, price is going to continue, indefinitely continue forming higher highs and higher lows, then you're going to have a problem. Because for the one or two times that price doesn't do what you expected it to do, then eventually you're going to blow your trading account and you're going to have nothing to be able to risk and make profits with. Okay, and that's why risk management is very important. Risk management is going to help you, protect you, so that whenever you take a trade, if you remember, we said that how to make money in the Forex market is you buy an instrument when it's low in price, relatively cheap, and you expect it to increase in value so that when it does increase in value, you're going to cover that or close that buy trade you took so that you pocket your profits. Or you sell it when it's expensive so that this is called shorting in trading, so that when it decreases in value, you're actually going to cover your short and then bank your profits, okay? Now, the thing is, whatever trading strategy you use, whether it's market structure, whether it's SMC, whether it's chart patterns, whatever strategy you are using, okay, your strategies might be completely different, but risk management is going to be across the board, is something that you have to respect, okay? So whatever trading strategy you're using, just bear in mind that trading strategy, whatever is telling you when to buy or when to sell or how to buy or how to sell or when to take a loss or when to take a profit, is not going to be 100% accurate. In fact, the trading strategy that I use only gives me winning trades like 40% of the time. But because of proper risk management, that 40% is more than enough for me to make a healthy amount of profits. Okay? So what I'm trying to make you understand here is if you're using proper risk management, okay? So, for example, if you're trading with a strategy that is only right 40% of the time, here's how it's going to be profitable. Okay? Let's say every time you're wrong, every time you take a losing trade, you're only risking 1%. You're only losing 1% of your account starting balance on every single losing trade you take. But then, whenever you're risking this 1%, you are aiming for a profit of 3%, for example. This in trading is what is referred to as risk to reward ratio, meaning you're risking 1 to make 3 times what you're risking on a trade. So if, for example, your risk per trade is 1%, then whenever you place a trade that you are risking 1% on, you are aiming to make a profit from that trade of 3%. Okay? This is what we mean by 1:3 risk to reward ratio, for example. So in this case, if you're risking 1%, you're aiming to make 3%. If you're risking 2%, you're going to be aiming to make 6%, which is 3 times the 2% which you're risking per trade. Now, what makes this interesting is that if you're going to be trading and you're saying that you're trading with a risk to reward ratio of 1:3, for example, you also need to understand that before risk management can work in your favor, or your technical trading strategies or whatever you are using in trading, there is what is known as the law of large numbers. You can't just take 1 or 2 trades with a trading strategy that is, after your back test, you've discovered that that trading strategy has a 40% or a 50% win rate. So you can't just take 1 or 2 trades and call it a day and say, okay, because my strategy has a 50% win rate, when I take 1 or 2 trades, or when I take 2 trades, for example, because it has a 50% win rate, then definitely one of those 2 trades is going to be a winning trade and one of those trades is going to be a losing trade. That's not how it works. And to give you an analogy here, it's almost the same thing like a coin flip. Even though a coin flip, statistically speaking, a coin flip has a 50-50 probability of landing on either heads or tails, you could have a coin in your hand now and flip it twice, and all of the time is going to maybe land on heads or tails. Does that take away from the fact that the coin flip has a probability of 50-50 landing on heads or tails? No. And the reason behind this is because whatever edge you have with your trading strategy, you need to take a large number of trades before that edge is going to manifest. So if you have a trading strategy that is maybe right 40 or 50% of the time, you need to take at least 30 or 40 or 100 trades with that trading strategy consistently, risking that 1% that you're risking per trade and aiming for the 3% in this example, before you can see the magic of the strategy. You can't just take 1 or 2 trades and say, okay, the strategy, because those 2 trades that I took were losing trades, the strategy doesn't work. It doesn't have any 50% win rate or 40% win rate that they were telling me it was all a lie. That's not how risk management works. You need to understand that for it to manifest itself, the law of large numbers needs to play out. Okay? So this is an example that I was showing you. Let's assume that you're trading with a strategy that has a 1:3 risk to reward ratio, and you took 100 trades with it. Okay? So you're letting the law of large number play out. Why did I say you're letting the law of large number play out? Because you didn't just take 3 trades and then you called it a day that, okay, this is, the strategy is going to show me how it works by that 3 trades. No, you took a large number of trades that is statistically significant. That's the word. Statistically significant. Okay? Now, what does this have to do with anything? Well, remember I told you that the strategy I use, even though I even just trade with a 1:2 risk to reward ratio on partials, okay, it's not even up to 1:3. With a 40% win rate, I still end up being profitable. So let's use the 40% win rate that I gave you as an example for this particular trade setup that we are a set of 100 trades that we're talking about that we're using as an example. So if you take 100 trades and your win rate is only 40%, this would mean that out of the 100 trades that you took, you only won 40 trades. Okay? And you lost 60 trades. But here's the kicker. When you lost those 60 trades, each one of those those losing trades only cost you a loss of -1%. Okay? So when you multiply those 60 losing trades by the -1% that you lost on each one of those losing trades, you're going to end up with a gross loss of -60%. But on the flip side, your winning trades, each single winning trade that you had, assuming you're trading with a fixed risk to reward ratio, Each single winning trade you had gave you a profit of 3%. Okay? Each single winning trade you had gave you a profit of 3%. So now when you multiply that 3%, positive 3% profit that each one of those winning trades gave you, you're going to end up with a profit of 120%. 120%. That's your gross profit. That is your gross profit. Now, when you subtract your gross loss from your gross profit, you're going to end up with a profit, net profit of 60% plus 60%. So look, even though you only had a strategy that has a 40% win rate, you still ended up making a 60% profit. Just think about it. If you're trading with significant capital, let's just use an example of, maybe $200,000 or $100,000 account. 60% profit is $60,000. Can you live off of $60,000? Of course, a lot of people can. Okay? And this is the reason why risk management is so important. Risk management is going to help you so that even if you encounter losing trades, which is inevitable in trading. When I first started trading, I thought there was actually a strategy out there or something I could do to just avoid losses 100% of the time. But it turns out that, and that was for good reason, because what I later discovered was as humans, we are averse to taking losses because they cause us pain. Okay, so it's the natural thing for you to do to try to find a trading methodology or a trading strategy that would help you to stay away from taking losses 100% of the time, because losses cause you pain and discomfort. Okay, it's only natural for human beings to feel, hurt by losses, and so you try to avoid them as much as you can. But let me tell you something that would, save you stress and thousands of years of pain and lost money and everything, okay? Because I've been there and I've done that. If you want to be able to trade for a living profitably and do it without causing, unsurmountable pain or stress with your health, you need to come to terms with the fact that in trading, losses are part and parcel of this business. Just like you cannot avoid death, for example, you cannot avoid losses. You can never ever avoid losses if you're trading. So the moment you accept that you cannot avoid losses and start taking steps to manage it so that it doesn't, cause you to blow your trading career, that's the moment that you're going to take, that's the step that you're going to take that is going to help you to become a consistently profitable trader. Okay? So moving forward, there are two risk management strategies that we're going to be talking about in this video. The first one is known as the fixed lot risk management. Fixed lots. Okay? And the second one is known as the dynamic risk management. Okay? Dynamic risk management. So let's move on to the chart so that we can continue. So you see, with the fixed lot risk management technique, the way it works is whenever you're taking a trade, the idea is that every trade you take, you're going to be placing that trade with a fixed lot size. So the fixed lot size which you're going to be taking that trade with, it doesn't matter how many percent of your account's capital you're risking on the trade. How many pips you're risking on the trade, not percent. How many pips you're risking on the trade. If you're using the fixed lot size, you're going to be taking your trade with that fixed lot size. So let me show you the pros and cons of using this technique, okay? So first things first, let's assume you're trading based on what we've been talking about for a long time in these classes, okay? You're trading based on market structure. What we have on the chart right now is you can see that price has been forming higher highs and higher lows. Lower lows and lower highs. Okay, so we're kind of like in a downtrending market here. But then, like I told you, price doesn't move in a up or downtrend indefinitely. Eventually, it's going to either get into a range or reverse that trend or something. But that trend is not just going to last forever. So as you can see, we had something like a downtrend for the past couple of weeks here, because price was forming lower lows and lower highs, lower lows and lower highs. But then all of a sudden, when price made this low, this lowest low, it couldn't make a lower high, okay? Because this high is actually higher than the previous lower high, okay? So price kind of changed structure. It went from forming lower lows and lower highs to now starting to form higher highs and higher lows. So we had a reversal in the trend, if you can call it that, okay? So we went from forming lower lows and lower highs in a downtrending market to now forming higher highs and higher lows in an uptrending market. Now the idea is, remember I told you, if you're trading based on market structure, you can either take trades based on a breakout technique or a pullback. If you are trading based on a breakout, you can see that this was what we would assume to be our previous lower high, okay? So when this price came here, it got rejected. And so if you're trading based on a breakout technique, you could have placed a buy stop pending order here with a stop loss somewhere around here, or if you're using the aggressive technique, or you could place it all the way down here if you're using the conservative trading technique. Now here is where things get interesting. You'd remember that I told you that most traders will advise you to risk no more than 1% of your trading account capital on each trade you take. So let's use this advice here to show you an example here, okay? So let's say you want to, this account particularly, this account has $105, for example, $105,000, okay? So let's say you want to place a trade, okay? But then the trade that you wanted to place, I'm going to be using the pending order just to, because price is way far away from here. So I'm just going to be using a pending order to show you how much the trade would have cost, the risk and everything, okay? It's just to drive home the point, okay? So let's assume that we want to take a trade and we want to enter into the market somewhere around here. It's a breakout trade that we want to take, okay? And then the stop loss, we are going to be using the aggressive technique. So the stop loss is going to be somewhere here, okay? Let me pick this tool to make it clear where we're going to be getting into the market with our trade and where our stop loss and everything is going to be. So let's say we're going for a 1:2 risk to reward ratio. We want to enter here at the breakout. This is the price we are entering. This is where our stop loss is going to be, and this is where our take profit is going to be, for example, okay? So in this case, let's say you're trading with a fixed lot size of 10 lots because it's a $100,000 account. So in this particular example, you can see that the distance from our trade entry level here to our stop loss is about 150 pips, okay? So since you're trading with a 10 lot size, let's see what our risk is going to be, because if you're trading with a fixed lot size, you can however much you're risking, whether you're risking 150 pips on the trade from your entry to your stop loss, or you're risking 300 pips, is the same thing you're going to be doing. So let's go to here, market execution. We'd use pending orders, and we're going to be using a buy limit, okay, because price is up here and it's supposed to be down here, that we are going to be taking the trade. So this is just an example, okay? So let's say this is going to be our entry is going to be 191.55. So let's say our entry, the lot size here, 191.55, 190.12. So 10 is the lot size we want to trade. And then our entry is going to be at the price 191.55. And the stop loss is going to be 190.12. And our take profit is here, 194.41. 194.41. This is, we're risking 150 pips on this trade. So because we are trading with a 1:2 risk to reward ratio, this is going to mean that 150 pips times 2, which is 300 pips, that's our profit target. That's how we arrived at this number, okay? I just configured these tools to make it easier for me to see these numbers at a glance, okay? So let's say we place this trade. This is the trade. Assuming we place this trade like this, look at what we have on the chart. If I hover my mouse's cursor over the stop loss here, that's the stop loss level here, you can see that we're actually risking $9,000 on this trade, $9,589.99. Now, here's my question to you. Is $9,000 1% of $105,000? Of course it's not. Because for a $105,000 account, then your risk is supposed to be maybe $1,050, okay? But we're risking about $10,000, almost $10,000 on this trade, which is almost 10% of this account's balance. And this is even using the conservative technique, because our stop loss is right below this higher low, okay? What if we were even using a stop loss, which is conservative stop loss, below all the way down here to the low that price couldn't break. So below this origin point, okay? So what if we're using a stop loss that was far there, okay? How much would we even be risking on this trade? You can see that when I hover my mouse's cursor on this, you can see we're risking almost 20% of this account's capital on the trade. So this is the negative side of linear risk management. Okay? Fixed lot risk management. Why did I say it's the negative side? It's because when you're trading with a fixed lot risk management, if you're trading using a trading strategy that is going to have variable distances between your trade entry level and your stop loss, then it's going to be very hard for you to consistently risk 1% of your trading account's capital on each trade you take. But assuming you are trading with a strategy that every single time that it gives you a trade setup, that strategy will give you, you're only risking 20 pips. So whenever you identify a trade setup, you're only risking 20 pips on that trade setup. Okay, then you can use that fixed lot size, because since your stop loss distance does not change, then having that risking 1% across the board for the particular currency pair that you're trading with that fixed lot size is going to be taken care of. You don't need to do the lot size calculation every single time. Okay, so that's its positive. Its positive is if you're using a strategy that has a fixed stop loss, like 20 pips every single time you take a trade for that particular currency pair, then if you're using a fixed lot size, you don't need to do any lot size calculation. You just place the trade and, move your stop loss to that 20 pips and that's it. You're done. But if you're using a strategy which has a variable distance between your trade entry level and your stop loss, then you have to use the next type of risk management, which we're going to talk about, which is the dynamic risk management. Because the dynamic risk management is the type of risk management which will help you to always make sure you are risking exactly no more or no less than 1% of the account capital, of the account balance which you're trading on every trade setup that you take. Whether you're risking 300 pips on that trade setup or you're risking 10 pips on that trade setup. So let me show you how to do that. So as you can see on the screen now, I'm using a position size calculator. Okay, this is a tool which just makes it easy for me to be able to risk a consistent amount of my account balance on any trade that I take. So using the same example from the previous example that we used, let's assume that we want to enter into a trade at this price. Okay, we said 191. Remember, we said 191.55. That's the trade entry level which we want to go in. And then our stop loss, we said we want our stop loss to be at 190.12. But then we want to also use the advice of traders, professional traders, who say we should never risk more than 1% of our trading account capital on each trade we take. So in this case, you remember I told you that 1% of this account, because this is a $105,000 account, is just $1,050, for example. So in this case, we want to risk 1% of this account's balance. So here we're just going to type 1. If we wanted to risk 2%, this tool, inside this tool, we'll just type 2. Okay? And here we'll just go back to 1 because that's what we want to be risking. Now, this tool has already done the math for us. It has done the lot size calculation for us. You don't need to pick a pen or scratch your head, use formulas and do all of those things. You don't need to do that. Just if you want to get this tool, go to nforex.com, search it on Google, and they'll give you the download. It's free. Okay, this tool, there are tools like it that don't even do half of what it does and they charge you like almost $100 for it. This is free. Just type nforex.com position size calculator on Google and it's going to give you access to the page. You download it. They have a detailed step-by-step guide on how to install it and how to set everything up. So once you're done with that, just look, this tool has already worked out the numbers and it has shown us that if we want to risk 1% of our account capital on this particular trade setup, then we need to place this trade with a 1.10 lot size. And to do that, we'll just go to the trading tab of this tool, click on trade, and then it's going to ask us. So we want to place a buy limit. Yes. The lot size is 1.10 and our account balance, this is our account balance. So it's telling us that since we want to risk 1% of our account balance, this is what we are going to be risking on the trade. This is the margin that is going to be required in because we are trading with the account has a 1:100 leverage or something. This is our entry and this is our stop loss. If you say everything here is okay, you just click on okay and it has placed the trade for you. And now we can go back to the main thing, hide the lines, and then when I hover my mouse's cursor over this, you can see that it has placed this trade for us, risking exactly 1% of this account's balance. And here's where things get even more interesting. Let's assume that we don't want to place this trade based on the aggressive risk management technique. We want to use the conservative risk management technique. So our stop loss is going to be all the way down here below this level. Okay. So in this case, let me just delete this order. And then I'll say I want to place this trade here with our stop loss below this area. So it's going to be at 188.70 for example, 0.60. Let's just say 188.60. That's where I want my new stop loss to be, this conservative, and this is my entry. So in this case, I'll now come here and I'll just type into this tool that I want my stop loss to be at 188.60. Now, this tool has already worked out the numbers. It's telling me that, okay, you still want to risk 1% of your account's capital? And my answer is yes. So the tool has already calculated and said that if you want to risk 1% of your account's capital, instead of placing a trade with a 1.10 lot size, you need to place this trade now with a 0.53 lot size to make sure that you're risking no more than 1% of your account's capital. And if I agree with that, I'll just click on trade and then come here, and you can see that the tool is telling me, okay, it's going to be risking this 1% of my account's capital, everything. Should it place the trade? I'll just click on OK and done. That's it. So you see, using this tool, I've got the power to actually, do the lot size calculation depending on the trading strategy that I'm using. Like I told you, if you're using a trading strategy that has a fixed stop loss, so every time you enter a trade, your stop loss is 20 pips and you're risking, and you're trading maybe one single currency pair, you can just know that, okay, since 20 pips is whatever amount of this particular account balance, I just need to be trading with X lot size. So every time you place a trade, whether it's on your phone or anywhere, you just place that trade with that lot size and that's it. But if you're using something like this, a trading strategy that has a variable distance between a stop loss and a stop loss and a trade entry every single time, like this one I just gave you an example with of market structure and pullbacks and retracements and breakouts and whatever, then you're going to need a dynamic risk management strategy like the one I just showed you here. Okay, so again, if you want to download this tool, just go to Google, type Earn Forex, EARN Forex.com. Then just type position size calculator for MT5 and MT4. It's all there. They will show you every single thing you need to do to set it up. And that pretty much brings us to the end of this week's edition of the class. But before we wrap up, like I keep telling you, this portion of the ITU Forex class is designed to help you guys to learn how to trade using manual trading techniques. You can see that the risk management we learned here, you need to actually use tools like the Forex position size calculator after you've done your analysis to know, if you're placing the trade, what lot size to use, how much to risk and everything. But we also have tools in the company which are designed to trade on your behalf. They will do the risk management calculation for you. They will do the market analysis for you. They'll place the trades for you. They'll do everything for you. Okay. If you follow our risk guidelines, you're likely not going to blow your account. You're going to probably make good profits while you're not even in front of your charts. So if you are interested in learning how to trade using the ITU Forex classes and also earning using our tools while you're out and about, then please reach out to us on the socials and we'll be more than happy to assist you, set everything up, get everything up and running, and then giving you the opportunity to take advantage of the Forex markets and make profits for yourself. Okay, so once again, thank you for taking time out of your busy schedule to come to this class. I look forward to seeing you guys in next week's edition, and as usual, go out there and crush the markets. God bless you all. Thank you very much.